Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan. Delighted that you've joined us today. Are you a busy professional, passionate about the work of your calling, yet realize that even though you love what you are doing, you're exchanging your time for money? You know that if you were to lose the ability to exchange time for money, your financial well-being will be in jeopardy. If you can relate, I have great news. Steed Talker Capital is an investment company designed for professionals to develop financial independence built on solid, passive real estate investments. Remove the anxiety of an uncertain financial future and go to steedtalker.com. Get your free one-page 10-step guide to passive real estate investing.
Enlightened investors, I am delighted to be back with you again today. Today with us is our guest, Sam Rust, who takes us on his personal journey from 0 to 100,000 in 3 years. Sam is a lifelong learner. He is a managing partner at LifeBridge Capital and a full-time investor in commercial real estate. Sam graduated from Thomas Edison University with a bachelor's in business management, and he currently lives in Colorado with his wife and 5 children. He has been active in commercial real estate since 2017 and has led the acquisition of a portfolio of properties across Colorado and Idaho with value in excess of $100 million. When not underwriting or touring properties, Sam enjoys spending time outdoors with his family, chasing beautiful views, ultimate discs, and big game. Before we get into our journey from 0 to 100,000 in 3 years, share with us a memorable experience from your formative years that helped you to be the person you are today.
Well, thanks for having me on your show, Alan. There's several moments that I could pull out, but maybe one of the more interesting, memorable stories was in my mid-teens. I grew up on a family farm in Idaho, pretty entrepreneurial from a young age. My parents encouraged that. And ended up, I had a sister who was born with pretty severe eczema. And so my parents tried everything for 5 or 6 years to try to cure or help and alleviate the condition. And nothing really seemed to work until one day, a more naturopathic doctor mentioned to my mom this substance called crocodile oil. So a little interesting, but crocodiles live in some of the nastiest water you can possibly imagine. They're always fighting with each other, with their prey. They never get infections. And some scientists did some research in South Africa and discovered that crocodile fat specifically is really antiseptic, has powerful antibacterial properties. And when you distill it down, you render the fat and turn it into a cream or an ointment that can be helpful for various skin conditions. So my mom got some of this product and it worked. It was the first thing that we'd ever tried that actually helped my sister. And so I was impressed. So the before and after pictures were absolutely stunning. I mean, I would have been maybe 15 at the time. So I just got my driver's license and I smelled opportunity. And so I went in and talked to the manufacturer out of South Africa. They just started importing it over. It fell in more of the nutraceuticals vein, so it wasn't as regulated by the FDA. Long story short, ended up placing an inventory order and they gave me exclusive distribution rights for the Rocky Mountain area. So Idaho, Wyoming, Colorado, Utah. So 15-year-old me, has $10,000 of crocodile oil and trying to figure out how to distribute that, grow that. So made some marketing materials and started driving around to local naturopathic doctors, chiropractors' offices, things like that, trying to raise awareness. And so for the next year or so, that's what I did in my spare time. And it ended up being, in a monetary sense, a pretty big failure. Turns out that 16-year-olds driving around and trying to sell crocodile oil, it fits way too many stereotypes. And it was really hard for people to take me seriously. But I did end up disposing of most of my inventory to a couple of folks. It wasn't a total loss, but definitely not the gain that I was hoping for. It wasn't the $1 million business that I had dreamt of. But one of the things that I learned along the way, Alan, was that I had to be completely invested in whatever I was pushing. And I think the where I was not completely invested in my crocodile oil venture was I was in it more for the money than in helping people. My reason wasn't big enough. I wasn't committed enough to make it successful. I think it could have been a successful business. That product definitely helps people to this day. But I didn't have the conviction or the wherewithal to follow through on that. And so that has really stuck with me. When people ask, what's a big failure of yours? I look back to that pretty consistently. And it's been, in some ways, a North Star for my career as I go into new ventures. How convicted am I about this venture? Whether it's real estate, I have a past in sales and business development in the automation world. So I've been in sales my whole career, and it's always been important. I'm really glad I learned that lesson early, that you have to have that conviction. You have to believe it's a good thing, not just because you're going to make money selling it, but because it's good for the people that you're hoping are your future customers. I think that's a really formative experience from my mid-teenage years that really impacts even today how I look at the world and how we evaluate new opportunities.
Well, no matter how that turned out, that is quite an impressive undertaking for a 15, 16-year-old person. So I congratulate you on that. And what a way to begin an entrepreneurial career. Well, you've moved into real estate and have been doing that pretty consistently for about 4 years now. And one of the things that you say is really important is identifying correct markets. Talk to us a little bit about what is a correct market, how do you find that market, and how do you evaluate it?
Yeah, top 3 rules of real estate that we've all heard time and time again. It comes down to location, location, and then location. And so for multifamily investing, which is what we focus on at LifeBridge Capital, there's a couple of lenses that you have to look at. You have to look at your macroeconomic environment. What's the big market that we're buying into? And so for that, we have chosen the Rocky Mountain region. And there's a couple of reasons for that. One, I'm pretty familiar with that. I live in Denver. I've lived in Salt Lake City, grew up in Boise. Those are the 3 main markets we focus on. And so we have some advantages just knowing those markets, having lived in those markets. We know the right side of the train tracks, et cetera, et cetera. And all those markets are growing above the national average. We want to take advantage of those macroeconomic trends and ride the rising tide. And so that's a big part of it. But then you dive into specific assets within those marketplaces. And it's really important to know, for instance, Colorado Springs, a town that we know very well, that we own close to 1,000 units in. There's good parts of town, there's bad parts of town, there's so-so parts of town. And you have to know where those boundaries roughly are. You have to know the various school districts. You have to know traffic patterns and growth patterns, more importantly. And we try to position ourselves through our value add strategy in parts of town that maybe are in the middle. They're neither the best nor the worst, but they're up and coming. And so in Colorado Springs, that tends to be anything near the airport. There's a lot of industrial development around that area. We track that very, very closely. And so, we have at the top asserting that Colorado is a great state. Colorado Springs is a great city, projected to overcome Denver in population by 2050. So we know that that's a market we want to look at really closely. Then we build that local familiarity, looking at various economic factors, who's moving into town, are other businesses investing there, and try to take advantage of both the micro trends as well as the macro trends.
On top of location, as many people have told us, real estate, particularly commercial real estate, is a team sport. So how do you go about putting your team together? How do you find essentially that first partner to help you on that road to success?
It's such an important question. And there's not a silver bullet answer. You ask 10 people, you'll get some general themes coming through, but you never can quite predict where you will find that partner. For myself, I had done my first syndication on my own with some friends and family. It was a small 64 unit in Colorado Springs and was looking to transition potentially into real estate full time, but knew if I was going to do that, I'd need a full-time partner and somebody who could, help raise capital, help systematize the business. There's just so many things in running a successful syndication business. I couldn't do it on my own. And I didn't come up through a coaching program or anything of that nature. I was pretty self-taught, listening to podcasts like yours, Alan. There's a lot of free resources out there. And so that first deal was just bootstrapped entirely on my own. But as a result, I didn't have relationships in the industry either. And so I decided to just start going to some conferences and try to pick the ones that are more aimed at the industry and not aimed as a funnel for coaching clients or even necessarily investors. So I kind of wanted that 201 level conference instead of just a 101. And Joe Fairless's best ever conference was one that I kept hearing good things about. And it was in Denver, right in my backyard. So I figured, well, I should probably go there. Ended up meeting Whitney Sewell, my partner at LifeBridge Capital. There, we're introduced by mutual acquaintances, shared dinner, and then Whitney actually approached me about partnering. It was a perfect point in time for both of us where we would both put a ton of effort in and we were ready to scale, but we needed somebody like each other to make it happen. And then there's a big dance that goes into that. Taking on a partner, the way that I look at that, it's a really serious decision. You're committing a lot of resources, a lot of time and energy into this person. You hope that it turns out well. You hope that there's a lot of benefit and that it works for the long haul. But there's a lot of due diligence that you have to do. You have to check alignment, foundationally. Do you have similar belief system? Do you have common foundation? For Whitney and I, our faith is very important for both of us. And we're very well aligned in that. And so that helps to have a common language that we could then explore other facets of the business and dive into some of the nitty gritty. But ultimately, you also have to take the plunge. And so shortly after meeting, I landed a contract on our second deal down in Colorado Springs, and we partnered in kind of a trial basis. And that was perfect for us, allowed us to go through the process of actually doing a deal without the pressure of, hey, we've signed up till death do us part. We can see how we work under pressure. We can see, are we compatible in those ways? And it was pretty apparent within about 6 weeks, maybe even sooner, that we were a great match, both in ambition and talent and ability. So, for us, we've been partners since early 2019. It's been a tremendous growth journey for us at LifeBridge Capital, but partnering both with a main partner like Whitney and I, we now are co-managing partners at LifeBridge Capital. That's one level, but there's also a whole nother level of the team that you can build out, whether that's your property management company, other folks to help build out, whether it's legal expertise, due diligence expertise, capital raising expertise. There's so many different avenues in real estate that are all necessary to get green lights before you move forward and actually close on these transactions. So I think working through referral is one of the best ways to go. I did that with Whitney. I talked to a lot of referrals, a lot of people that he knew, his pastor. And then as we talked to other folks, you don't have to vet them quite as much if you're not going to be a long-term partner, but still talking to references, I find is really, really helpful in trying to understand what makes people tick. And are they motivated by short-term gain, or are they motivated to build long-term partnerships? And that's one of the things that's so attractive about real estate is especially commercial real estate. It's not a here today, gone tomorrow type industry. There's a longevity to it, and you make lifelong friends in this industry, and there's opportunity for tremendous gain if you take that long-term view. And I want to work with people who have that long-term view. So we prioritize that as we're evaluating future strategic partners.
Well, what was it that first clicked that it goes, yeah, I think this might be a worthwhile partnership?
I think for Whitney and I, it was that common faith background. We both trust the Lord for our salvation, and then for that in our business as well. And so for both of us, we had been praying about who would be that right person, and it would need to be somebody with that common background. And so that was like the number one thing that had to be cleared, the first hurdle for both of us. And then beyond that, I think our strengths and our personalities overlap really nicely. I'm more focused on asset management and acquisitions, especially acquisitions. I really enjoy putting the deals together, underwriting, evaluating, building relationships with brokers. That's my jam, if you will. And Whitney is a fellow podcaster and has just created a lot of content for folks in the space. He's interviewed over 1,000 real estate professionals over the last couple of years and is fairly well known and is very good at building out processes. And so he's more focused on the capital raising, building internal processes, building out our marketing team and our internal ops team. And so I'm free to go pursue the new deals, build that funnel while Whitney's building the investor funnel. And it's been a great synergistic partnership in that way as well.
And clearly very successful. Well, thank you for sharing that. So let's talk about this process of evaluating deals. You're the part of the team that goes out there, looks for these deals, and first thing you have to do when looking at deals is evaluate them. So talk to us about that process.
Yeah, I mean, that's number one thing we look for in real estate. You have to make your money on the buy. You have to buy correctly. So that means not overpaying. Obviously, it means paying attention to the location, as we talked about earlier. But we have a multi-step process that we go through. And it kind of depends on the market that we're in. Colorado Springs is a market that we're very familiar with because we've transacted a lot there. We own a lot of properties. So it's very easy for us to run rent comps. So maybe I'll use that as an example. I'm underwriting a couple of deals there now. First thing that I do when I get a performance, I have my assistant load in the broker's assumptions with the T12 information, so the historical information off the property, into our basic underwriting model. And then I just see, okay, what's the IRR in our model if I just take everything the broker says as gospel? And half the time or more, we won't even get above about a 10 or 11% IRR. And then I know, well, it doesn't matter what I do from here. This is just a dud. And so that's an easy way for me to screen out any projects that just aren't going to be a fit and I don't have to waste time on them. That's a very simple yes, no. But if we get something that's in the mid-teens or higher, then it calls for a little bit more due diligence. So I'll, in Colorado Springs, run my own set of rent comps pretty easily. We have a couple of tools that help us do that. I'll reach out to my property manager and just say, hey, here's this property. Could you run your own set of rent comps? So I'll have mine and I'll pull my property managers. We'll compare those. And then we usually derate that by about 5%. We'll take the lower of those two assessments and then subtract about 5% out of that and put that into the pro forma side along with some basic expense adjustments, whether it's higher or lower, and then run another analysis and see, okay, where are we at? Are we still in the mid-teens from an IRR basis? What's our exit cap rate? We take a close look at that, try to expand that by 10 basis points for every year that we hold the project. For value add projects, that cap rate, that exit cap rate is a little bit of a moving target. We don't want to take just the T12 cap rate over what we're proposing paying for it, because that could be totally skewed. I've seen some projects trading at a 2.5 cap, but if you can stabilize it to an 11 cap, I don't mind that. But your market cap, your exit cap is determined off of market cap. So we have to figure out what's the market for a class C asset, a C plus asset that maybe we're going to be able to take to C plus plus or maybe a B. And so in our market right now, maybe it's 4.5 is market for truly stabilized product in the 70s and 80s. So if we're holding it for 5 years, we'll push it to 5 or a 5.15 exit cap. And so we're paying attention to all those factors, run the analysis again. If it's still looking good, we'll dive really deep into property taxes, into some more ancillary factors, the exact location, school district, crime rates, things of that nature, and really get very as precise as we can with some of our assumptions, dive into our rent growth assumptions, make sure that we're in line with historical norms and also taking into account what we believe will happen in the future. We certainly aren't underwriting to 5% annual rent growth or anything like that, but trying to that's been, frankly, a challenge right now is what is rent growth going to be over a 5-year period? Our answer is usually to backload rent growth. If you front load rent growth, you have a compounding issue. And so we find it more conservative where, if we want to average across the life of a deal, maybe a 2.5% rent growth, we might say 1% rent growth in the first 2 years and then 3.5% in the back 2 years. So that if we miss on that back part, it doesn't affect the model near as much. And if we beat it early on, we're set up more so to exceed our projections. We really try to, when we put together an investment summary for our investors, show something that's quite conservative, not divorced from reality, but different from what I think will actually happen. There's a difference in our underwriting from what I think will happen to what we model will happen. It's usually quite a bit more conservative on what we show investors because in a sense, in a very real sense, I'm putting forward, not necessarily a promise, but it's a projection. I'm asking you to invest in a project and I'm putting numbers in front of you. And I need to be able to stand behind those and be able to explain how we got to those, how we controlled for various risk factors. And so, oftentimes I'll be talking to individual investors. We'll walk through that. And then they'll ask, well, what do you think is going to happen? And we'll run through a whole nother set and I'll show them, here's what I think could happen, but we don't market around that. We don't promise that. We don't publish those, just to err on the side of conservatism.
Well, it is definitely challenging to find properties that are going to have an internal rate of return in the mid-teens. How are you going about that? What are your cap rates running there in the Colorado Springs area now? 3% and 4%, is that?
Yeah. So for value add stuff, it's going for 3.5 to 4.25-ish on a T12 basis. And you can probably stabilize that to anywhere from a 5.5 to a 6.5 cap. So there's still some pretty good spreads that you can achieve, but cap rates have dropped precipitously, probably 150 basis points over the last 3 years. And that's pretty true, not just in Colorado, but Idaho as well. Idaho probably has even lower cap rates because the supply is much less. So there's just a lot, the stuff that is trading is newer, and that's what's pushed us more towards development. So yeah, cap rate compression is a real thing. You have to be very careful to not build that into your business model. It's great if the tide helps you out, if the prevailing wind pushes cap rates down. That's not a sustainable business strategy. So we continue to underwrite to exit cap rates in the fives, depending on the specific property.
Well, you have talked a little bit about building relationships outside of the partnership. Tell us a little bit more about the processes you go through and how do you develop the relationships with your brokers, with your attorneys, your lenders, your investors? What's the process?
Yeah, maybe speaking directly to brokers for the type of stuff that we buy, they control an outsized portion of the market. Their full-time job is to call these owners, build relationships with them. They're completely commission-based. And so they have a tremendous incentive to stay in front of these people. And generally, they tend to build stronger relationships than newcomers to the industry. And so it's really important to be able to build relationships with those people because at least in our markets, they tend to control more than 75% of the deal flow for properties that have 100 doors or more, which is kind of what we're shooting for. And so, starting out, that was probably the biggest challenge when I first got into this business was how do I get brokers to pay attention to a 20-something and give me the time of day and show me deals? And so the strategy that I adopted was relatively simple, but I went to LoopNet. And a lot of people know LoopNet as a place deals go to die. There's not a lot on there from a multifamily perspective that I think pencils. But I went there to figure out what are the brokers that are active in my area? Who's pushing stuff out? And generally, that's not the top tier of brokers. Most really institutional grade brokers aren't going to put their stuff on LoopNet. But you're going to get kind of the B and C level brokers who maybe play in the smaller stuff and the larger stuff. They're not quite as honed in on the only institutional grade, 150 doors and up stuff. And that's where I wanted to start. I knew I couldn't buy something that was 200 doors right out of the gate. So I just looked what shops are active. And then I would go look at those brokerage firms and I would look for somebody who was about my age. So, early in their career, had maybe won an award or two at their brokerage. So there was somebody who had been a high performer, not just somebody starting out. And my theory was, hey, they would like to work with somebody like me. They see a little bit of themselves in me. They're willing to take a chance on me. They're successful. I'm selecting for people with awards, but they haven't made it yet. And they don't have their 7 favorite clients that see everything and that every deal before it makes its way to me. And so I would call those brokers, target them, try to build relationships with them. And one of those brokers brought me my first deal. He gave me access to their website where they floated some deals. And I found a deal there that penciled for us. And that was our first transaction. So, that's a very specific case, I think, where you're new to a market and you're new to multifamily. Once you're in the industry, I think the dynamics change a little bit. Like any industry, there's a whole vernacular you have to learn. You have to be able to speak in cap rates and debt yield and markets and what type of value add do you want and have realistic expectations. Some people, they'll call brokers. I hear this from brokers all the time. They'll complain. I'm getting calls from people who want to buy a 10 cap. And the fact of the matter is those just don't exist anywhere. Maybe in like middle of nowhere, Iowa, maybe, but probably not even there. It's just people have to be realistic with your expectations. And so, for myself, now that we've built a little bit of a reputation in the business, we have a reputation for closing. Hold your word when you tell a broker, only commit to what you know you can commit to, and then follow through. And that reputation, it's so easy to mess it up, but just consistently doing the right thing will get your name out and about into the broker network. And now I have more brokers calling me than I do outbound. And just because we have that reputation, particularly in Colorado Springs, where we've bought a lot of property over the last 3 years, we have a reputation for not retrading. Now, have we gone back and negotiated a little bit on some deals? We have on one particular instance where the buyer did not alert us to some foundation issues. So we went in and found that, but we found a way to make it work. We found a good compromise, and brokers appreciate that. They don't want to be retraded because then they have to work twice as hard for the same commission amount. And so doing everything we can to be easy to work with, quick to turn.
And they lose credibility with them.
Yeah, they're trying to sell themselves to future buyers. They don't want to have that black mark on their record. And so we've taken down some pretty hairy deals. We closed a deal last year, March 19th, which was kind of the week that all hell broke loose in the financial markets because of COVID, but we found a way to get it done. And so it's things like that help grow your relationship over time.
Well, it's important to have team members. And of course, part of those team members, and I guess perhaps the most important part of the team member, are the investors. And you've mentioned a number of things about building trust with them, conservatively underwriting, consistently performing. What are some other things that are important in building trust with the investors?
I mean, this is going to sound trite, Alan, but honesty. There's going to be bad news as you operate properties. Things are not going to go according to plan. That I tell investors this at the outset on every investor call that I have. I said, just so you know, the pro forma that you're looking at is not going to come true. Not one bit of it. Now, I think that, it's going to be a little bit better in some of these areas, but it might be a little bit worse. But the only thing I can guarantee you is it's not going to come true exactly. So setting those proper expectations, but then as life happens, as the world moves, communicating with investors. So when you have a property where you have 2 boilers go out in the same week, and you have a hailstorm that rolls through, and you have turnover in your leasing staff, and that impacts occupancy. You're keeping your investors abreast of those things. Investors generally are forgiving if things are not going exactly to plan. Most people that are investing have experience in the business world. They know that things are going to go wrong. It's about how you respond to the things that go wrong that matters, not so much that you control for everything that can possibly go wrong. And so we try to communicate, where we do communicate monthly with our investors on every single property. I think that's a big thing. We pay monthly dividends. And so investors get used to that repetition, that they see your stuff top of mind in their bank account and in their inbox on a monthly basis. And again, providing that level of transparency so they have a good idea on what are the headwinds, what are the tailwinds, and where is this property performing year to date or plan to date, as it were.
Well, it has been a pleasure visiting with you today, Sam. Before we close out here, tell our viewers and listeners how it is that they can get in touch with you.
Yeah, for folks who want to hear more, they can find more information on our website, lifebridgecapital.com. You can also reach out to me on LinkedIn or Twitter. I'm active in both of those platforms. And my email is sam@lifebridgecapital.com if you want to reach out to me directly.
Well, Sam, one last question. When it comes your time to leave this world, what will you look back on with your greatest sense of satisfaction and fulfillment?
I think my family. I want to be a good steward of the things that I've been given. And as you mentioned in my bio, I'm married to a lovely wife, Becca, and I've got 5 kids with number 6 on the way. And so I hope that I can raise my children well, that they will grow up and be productive members of society. And I think that will be my best accomplishment. If I can get to that point, if I can reach the finish line of life and have helped my kids launch well.
Well, Sam, it has been a pleasure. Thank you so much for being on the show today.
Thank you, Alan.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.